news about my case, uh, that is overreactions of stock market and its implications for investor behavior. It's a case of DLF Limited, which very aptly tells the story of illusionary wealth creation and wealth destruction in stock markets. So, stock market anomalies have always been a matter of great concern for business, financial intermediaries, economy, and the business as a whole. So, as the theme of the conference is very apt, that is how to manage business in a volatile, uncertain, and complex and ambiguous environment. Same are the adjectives which can very aptly attach to stock markets, because stock markets are the most uncertain element which every business or every investor wanted to know for so many years. But the reason, because they were solely dependent on the portfolio management theories. They were just putting only the logical factors to it and only the financial information to it, that they were not able to identify fully. They were not able to give the justified reasons for the erratic behavior of the stock markets, because there are certain behavioral factors which come into play when when stock market is performing, because investor is very emotional for his money. So the two extreme emotions, which are greed and fear, which govern this stock market. So if our analysis is just based on the financial information and the fundamental information from the financial statements of the company, that won't give a true view of the analysis of the particular stock. So we have to go beyond that financial figures and identify what are the irrational factors and what are the behavioral factors which are driving the investors towards taking those irrational decisions. What happened with the case of DLF was that DLF Limited was a very good brand name when this IPO was, because basically this case I have written during May 2015, after analyzing the performance, after analyzing such an erratic pattern of the stock of DLF Limited from June 2007 to this May 2015, when in such a short span of time, within 7 years, no one was able to predict what made the share go up so high beyond the unbelievable figures, and how that strong brand name fell down so much in the eyes of investors that it's just revolving around just a meager price of only 115. So if we take an analysis if I tell a brief story of DLF, DLF is Delhi Finance and Land Corporation, which is a very old, which was very old organization. Around 1947 to 1961, it was in the business of building colonies in the area of Delhi. But when Delhi Development Authority was formed, so all the construction work went under Delhi Development Authority, and DLF take out itself from the real estate sector and diversified into various other sectors, such as in cables and batteries. But then the real estate sector was again took interest of the DLF Limited when its founder KP Singh, a very intelligent business person, we can say, was very opportunistic also, who took a very good analysis of the opportunity of investing beyond Delhi, that was in Gurgaon. Gurgaon was not well built at that time, so it started putting investments in real estate sector in Gurgaon, and so many finest works of construction goes to the credit of DLF Limited. DLF Golf Course is one of the biggest golf course in whole Asia, and DLF City is home to one of the very big corporate houses of India. So DLF, with the logo of Building India, it was moving very fast into real estate sector, and that name of DLF was just got so prominent place in the people of the country, that when its IPO was floated in June 2007, at a very quite expansive price band of 500 to 550, when its EPS was just around rupees 11.78, and but still the surprising point about this IPO was that even at the expensive price band, it got oversubscription of 3.47 times, which was definitely an overreaction. It was an overreaction that how a certain company which is issuing an IPO at already an expensive price, but still getting this oversubscription of 3.47 times. There were so many reasons to that. If we analyze this case at this point of time, there were so big names attached with the DLF IPO at that time. This Kotak Investment Banking and DSP Merrill Lynch, they were the global coordinators to uh, this grand IPO, and Lehman Brothers was the senior book running manager, lead manager to the issue. Dutch Asset Management, HSBC, Dubai Investment Group, LIC, SBI, Reliance Capital, and Reliance Mutual Fund were also among the domestic investors, domestic and foreign institutional investors. So these big names give a representative heuristic to the investors that if this if these such big names are attached to this branded IPO, we can say they didn't go beyond that heuristic, and they just took their decision on the basis of heuristic. Is basically a rule of thumb made in your own minds, a very small analysis of available information that you don't go beyond checking beyond that to check whether that information is right or wrong. You just take a decision, because at that time you have to, investment is such a field that you have to go in a very quick decision making, otherwise the probable profits are lost, an opportunity is lost. So basically there are three, at this point of time I'll like to discuss the three kinds of heuristics which are popular, which are basically which we can classify into, because heuristic leads to overreaction, and these overreactions takes a form of herd behavior among the investors, which is responsible for causing a stock market bubble. And this busting of the bubble, this making of the bubble is this illusionary wealth creation, process of illusionary wealth creation. This forming of the bubble is illusionary wealth creation, and the busting of the bubble, it's the wealth destruction of the investors. And the second kind of heuristic which I was telling about is represented. First is availability heuristic. Availability heuristic means the investors rely very quickly on the information which is readily available. He doesn't go beyond the information which is hidden and which is not readily available, because that investment is such a field in which quick decisions only matter, and the decision, if not taken on the spot, the opportunity is lost. So this is a limitation with the analysis of stocks, that if you are not able to take the decision by at that particular point of time, taking too much of the information and then analyzing that. So, but the investors were not aware that they are being a part of certain herd behavior, and they just took the this availability heuristic, that because information which was available everywhere was very positive about DLF. No one went beyond that information and took pain to take the analysis of the financial fundamentals of the company, which if we see in I will tell later on that at that time the company was burdened with huge debt. Because of that, that was the main reason that this stock is not able to gain after that. And the second kind of heuristic is representative heuristic, when so much big names are attached to a particular investment, then people think that if such big names are attached, they must have gone through the required analysis, and we don't need to put ourselves into much analysis, and we can blindly follow them. That is called representative heuristic. This also is a reason for herd behavior among the investor and leads to overreactions in the market. And third one is saliency heuristic. Saliency heuristic is that people extrapolate the present into future, that this kinds of event will always repeat it in the future. If it's a negative, negative will always repeat. If it's positive, positive will always repeat. So when the DLF price was rising such exponential, with an exponential growth, people took that, extrapolated into future, that they will go on increasing forever. But that can never be the case, because if there is a bubble which will burst in short run, that short run may be a long short run or a small short run, but that has to bust. So what I feel, if we look at the table, can we move the slide to that table, which shows the certain financial figures about DLF. It tells about debt. Debt of the DLF was in 2607, when its IPO was floated, it was 11,201 crore rupees debt was due on DLF, and its interest burden was 356 crores, and its yearly profits were 620 crores only, with an EPS of just 2.68. These were very, not so attractive financial figures that could justify that oversubscription of 3.47 times of a share that was already issued at such a high price. So definitely irrational factors were responsible, the behavioral factors were responsible for this illusionary wealth creation, but the wealth destruction of the people were really real. So these kinds of phenomena from the stock markets cannot be ignored and need to be studied in depth, so that the investors should increase their prudence while investing, so that their hard-earned money is not lost, and their confidence, the investor confidence, which is so much valuable to a business in this VUCA world, investor confidence is so much of value that we should not let it lose so quickly by just the force of just these emotions or these overreactions or of these heuristics. These need to be made aware of the people in the investment field. That was the purpose of this paper or writing this case, that if the investors are somehow able to understand the rational irrational factors along with the irrational or emotional or behavioral factors which are responsible for the movement of the stock, they won't get exploited by the emotions of greed and fear. Rather, they will be able to understand this greed or emotion phenomena in the market and can take that intelligence for making money from the capital markets. So capital markets are never bad. Bad is a speculative investment which is based on the emotions of greed and fear. Rather, if we focus on to value investments, that the value investment is that which takes into focus the financial information, the rational, the behavioral patterns, along with certain micro analysis, which would never lead to the destruction of a wealth of an investor, and that will definitely add to investor prudence, which was the purpose of this writing this case. So if we take a look at the table, can we move to that slide please? Table which shows the stock prices of the company from 2007 to 2015. It shows a very erratic behavior. In 2006-7, June 2007, when it was listed at a price of 525. Then within just a period of 6 months, it was able to double its price to 119.99. Then in January 2008, this bubble reached at its maximum point. It was 1225, which is just unbelievable for the stock, that without any such financial performance in the view, this within just a period of 6 months, company was able to reach at a growth of 150% in the share price. That was really unbelievable, and no rational factors could justify this. And if we take a look at the further stock figures, company was not able to reach that figure even till date, that is May 2015, when I brought this case, it was revolving around just 115, and it doesn't seem that company will ever be able to reach beyond that, reach anywhere near that highest price of 1225. So the investors which would have invested at such a illogical price of 1225, they are definitely going to lose their illusionary, their hard-earned money through this illusionary wealth-making process. So that was the very noble objective of writing this case, that hard-earned money of investors should not get lost, and the very valuable investor confidence, which is very valuable for a business today, business managing business, should be retained in my views about my